Well, let's get to our next management on the show, DCB Bank. The deposit growth, well, that was strong. The problem is on the NIMs as well as on the slippages. To understand more about what went on in the past quarter and what's the way ahead, we have Mr. Praveen Kutty, the Managing Director as well as the Chief Executive Officer at the bank, who joins us. Good morning, Praveen, and good to see you, and thanks a lot for joining in. Well, let's get your view on both these two factors. Your quarterly annualized slippage ratio, well, the run rate has been more than 3% for the last many quarters, close to 14 quarters. Tell us what's the guidance on this number going ahead. In absolute terms, I think it was 370 crores. So what's the way ahead? And also on NIMs, because both these two are the problem pockets.
Right. What I would like to talk to you about is that in Q1, which is a difficult quarter, where liquidity was tight, we've grown the deposit 20% plus YOY. And the loan growth also has been up to our expectations, 18.9%. On the NIM front, there are two factors at play. One factor is that our long-term deposits booked 2.5 years back, 2 years back, are coming up for renewal, and they're getting renewed at a much higher rate than what they were initially contracted for. So this trend, I would expect to continue maybe till mid of Q3, after which the growth in volumes would reflect in growth in non-interest income. That's only one part of the story. The other part is that we have had one-off interest hits on account of the penal interest now being substituted as penal charges, and secondly, on penal interest, interest reversals on account of demand draft disbursals being accrued from the time of disbursals, moving on to the time the demand draft is handed over to the customer. So this cleanup has happened largely in Q1. There'll be some remnants left in Q2 as well, but after that, one expects to see the NIM to rise.
Right.
On
so
your
Praveen,
second point, which is on the slippages.
That's right, Praveen. If you could give us a couple of numbers, then you're expecting the NIMs to improve. Explain to us why it was under pressure. Give us the range then for the year. What should the NIMs look like? And you were getting to the slippage numbers as well. Please go ahead.
Our guidance continues to be between 365 and 375. Currently, it's at 339. We'd expect a bounce back in Q3, and I don't see any change happening on that count, even after taking into consideration the increased cost of fund stabilization happening in Q2.
Okay. Mr. Kutty, so on NIMs, could you give us a sense? What would be some guidance would be helpful, sir.
365 to 375.
Okay,
365 to 375 on a steady state basis.
Got it. And in terms of the...
On a steady state basis.
Okay. In terms of slippages and non-performing ratios, what would the guidance be?
Sure. So what we see is that while we would like the slippages to be below 2.5%, the segment that we operate in is such that the slippages are elevated, and so is the recovery and upgrades. If you see even the last quarter, our recovery and upgrades was 77% of the slippages. In Q4, it was 95%. So a significant portion of the slippage is because of gold loans, which are small ticket nature, and they are overdraft. So the discipline of payment is not is not regular every month, but it's in a sporadic manner. So we're getting the customers to change, but we're talking about a large customer base of gold loan where there is lack of discipline. There may be delay, but no denial.
So so actual credit loss is very low in that segment, right?
It's extremely low. I mean, if you were to see the total NPA on a stock of close to 5,000 crore is about 44 crores in the last quarter, in June 30th. And the aging is very, very limited there. So, but the nature of the beast is that the slippage will be slightly elevated, and so will the recoveries be.
Okay. Praveen, I wanted to understand in terms of loan growth, right? What kind of sustainable loan growth are we looking at in FY25 and FY26? And which is the segment that will contribute the most to loan growth?
I expect us to grow double the book in about 3.5 years' time. So even if we were to look at the current rate of growth of 19%, between 19 and 20%, we should reach there comfortably. The segment that we are concentrating on continues to be secured. Mortgages is a big play. Within mortgages, LAP, business loans, are a critical thrust area for us. Within the SME segment, we're going to concentrate far more on overdrafts as compared to normal lending to the MSME segment. The ticket size will continue to focus on less than 1 crore. So you will see an elevation in ticket size also coming through from our stock as well as incremental loan portfolio is concerned. But clearly, self-employed customers, MSME customers are the focus area, and secured retail small ticket lending is the credo.
Yeah. Okay. All right, Praveen, before we let you go, when does the slippage ratio come down to 2.5%? That's where you see it headed. So by when, if you could give us a guidance there? And what about your return ratios? Do you see the ROEs continuing in this vicinity of around 12 to 13% in the coming year?
No, I would tend to see that the 2.5 is something which we are gunning for in about, it'll take about 6 to 9 months' time. So we should see the slippages coming down. As you see, the gold loan, if you were to exclude the gold loan, that comes to about 2.2 to 2.4%. That's a slippage. But on the gold also, we are trying to instill the discipline by institutionalizing standing instructions, ECS, etc., so that the discipline is somewhat replaced by a system-based repayment coming through.
Okay, Mr. Kutty, we'll leave it there for now. Thank you very much for joining us to talk about the numbers, and we'll love to have a more detailed chat later. Thank you very much, sir.